Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Markify. I'm your co-host, Joel L. Cannon, along with Brianna Valesky, and we have Chris Temple on the line. He is the editor and publisher of the National Investor. Chris, how you doing this morning?
Great. Glad to be back, Joel. How are you?
We're doing good. Well, we always we talk a lot about the technicals on the show, and we also talk about the fundamentals. But that's something that you spend a lot of time on, and been doing some work on. And just looking at some of your comments here about are we entering a deeper, darker circle of hell where the forces of inflation and deflation are colliding? And talking about Japan is this best example. Would you like to comment on that? That's a pretty hefty statement there.
Well, I guess it is. Well, what we're seeing increasingly happen is that despite massive amounts of credit creation over the last several years, much of the world is kind of grinding to a halt. Japan was telling us a year ago that the inflation was going to come back, growth was going to come back. All of those things have been shot to pieces because they're getting neither. Mr. Kuroda recently from the Bank of Japan decided he was going to really go nutso as far as expanding the balance sheet. The state pension fund is putting a pile of money into all different kinds of assets everywhere in the world. And, sooner or later, the markets are going to come to the realization that this is not the answer to structural economic problems, in Japan especially demographic problems, where the population is aging. And I don't care how much money you print, you're not going to have a booming economy like you did a generation ago. And we're going to get to the point. We're not there yet. Every now and then we see a glimmer of it. But we're going to get to a point where the deflationary forces, as those are defined in the form of falling prices, slowing economic activity, and the part of it that scares central banks the most, potential credit crises when people can't keep all of the balls in the air from all the obligations they've taken, those deflation pressures are beginning again in the recent past to overwhelm all of the monetary inflation pressures to keep them at bay. And so what happens? Do the deflation pressures win? We get a repeat of 2008? Or, which I think is more likely as we go into the future, do the central banks, which really don't know anything to do but this, do they panic? And everybody does what Mr. Kuroda just decided to do, and they all really put the accelerator through the floor to try and keep these things from overwhelming us.
Well, is it that, I mean, we had the QE and the QE and the QE, and it worked pretty good for us. I mean, so what are the structural differences in the Japanese economy and our economy that, would prevent the QE from, having the same desired effect that you had in the United States in their country?
Well, two things basically, Joel. First of all, is that this has been going on a lot longer in Japan. It's become pretty much intractable. I mean, their stock market bubble peaked in 1989. The real estate bubble peaked a few years later. They've never approached what the prior highs were. And granted, relative to what we saw in 2000 and 2007, they were even more extreme. But the crash was so devastating over there that the whole economy and the markets even have never really been able to catch their breath. And it's been the Bank of Japan and the central authorities over there on fiscal policy have continually been fighting from behind. So the whole deflation mindset has become much more intractable there. And what happens with people, investors and consumers alike, when you have an environment like that, is they needs be become more frugal. They don't go out and spend with wild abandon. They don't throw money into equity markets and so forth. You can talk all you want about how cheap some things in Japan look compared to others. Tell the Japanese people that they don't buy it anymore. That's the broad problem, number one, and really a corollary of that. Secondly, is that the population is aging. You don't have nearly the number of people that are in the workforce and the younger people over there that are going to support the level of the economic activity needed to service everything. And that's another reason why things are grinding to a halt. Those factors are less bad here. And we have some other advantages that have made the U.S. economy and markets relative to Japan and Europe look better. But a lot of people have used different metaphors for this, whether you want to call us the prettiest baby in the ugly baby nursery or the cleanest shirt in a dirty laundry hamper. We at least have that much going for us here right now.
Okay. So let's shift gears a little bit here and talk about interest rates. And boy, the expectations for interest rates are, some people think, well, they eventually got to go up, and eventually we're going to see some kind of inflation. But you're looking at long-term Treasury yields will continue to fall in 2015, and comment on that, and then investment themes that investors can take advantage of this trend.
Well, Joel, I think we're going to continue to see interest rates fall when most other people were saying at the beginning of this past year that rates were going to continue their rise from late 2013. I was one of the few saying that's absolutely not going to happen. All year long, by far and away, the biggest anchors to our recommended portfolios have been long-term treasuries and a basket of rate-sensitive stocks, most all of which have done very, very well, better than the market averages. And there's a lot of reasons I think that's going to continue. First of all, Jeff Gundlach of Double Line was interviewed the Monday before Thanksgiving on CNBC, and his term was, it's unthinkable that Treasury yields in this country can rise very much when elsewhere you've got 10-year paper at 40-some basis points in Japan, despite that government's promise that it's going to destroy its currency if that's what it takes to try and revive things. In Germany, the 10-year yield is 70-some basis points. In France, it's half of what our level is right now, about 228 or 230 on a 10-year yield. And especially if you're a foreign investor and you're looking around the world at where you're going to get yield on sovereign debt, you're going to put money in treasuries. And really, all year long, that's one of several reasons why our treasury yields have continued to trend downward, even as the Fed was unwinding its overt, and underline that word, folks, overt QE program, because there's more than one way to skin a cat, and the Fed is in there more than people realize, continuing to keep interest rates compressed. And that's not going to change. Banks are taking their excess reserves now and replacing the Fed's outright purchases with their own. And you've got the interest rate differential, like I said, with other countries. And last but not least, I continue to believe that as time goes on, we are going to find that the U.S. is not forever going to escape the funk that's enveloping the rest of the world. We had that surprisingly good first revision rather of the third quarter GDP number come out showing 3.9% growth. But within that report, there were a couple of red flags, the biggest one being that corporate profits plunged in the third quarter. And we've had everybody from Costco to IBM to Walmart, Coca-Cola, Kellogg's, and others tell us that the dollar is starting to hurt. Exports are hurting for multinationals. Their sales are down. Their earnings are going to be hit in the fourth quarter. We are not going to get by much longer without having some effects on our economy and our stock market from this growing weakness everywhere else in the world. And I think once that sinks in, and I for one throw in with Ron and Sana, who put out a really good piece on this recently, there's no way the Fed's going to raise interest rates, in my view, at all in 2015. And when that sinks in, I think we're going to see that the 10-year note eventually goes back below the 2% level as we get into 2015. And it's interesting, and one more thing on this, Joel, as Gundlach pointed out too, we have seen stocks, at least as represented by the S&P and the Dow, hit all-time highs. We've got the supposedly great, robust economy in this country, and with all of the reasons why yields should be moving up, they haven't. And that tells you something. It tells you that there's still forces behind the scenes keeping rates compressed. And I think that at least some people out there, to the extent we can say we even have a bond market, which is one that's so heavily influenced by the Fed, people that are making market decisions are betting on things not being as rosy as is being said by some.
Chris, I mean, you've been on a few times, and I've known pretty bullish stances on the markets and stuff. But I think if I take all your comments as a whole here today, it seems like you're not as bullish and maybe even a little bit bearish on this market.
Well, as far as the stock market generally, my belief in a really big picture look at things, Joel, is that I can easily see in 12, 15 years from now the Dow might be 40,000. But the storyline is going to be not that the Dow got up that high, but that Dow at 40,000 is not going to buy you in goods and services and necessities of life what the Dow at nearly 18,000 will today. That's the big picture. It's really what we've had for 30 or 40 years is that same thing. The average household is not any better off with a Dow at 18,000 than it was with a Dow either side of 1,000 when I first got in this industry. It's all a function of a lot of money being printed, a lot of financial alchemy going on. Between here and 40,000, we're going to have some setbacks. I think we're overdue for a more significant one than we even saw in October. But my big theme right now is that I see in the next year or two that we're going to go toward an environment similar to what we saw in the 1970s,
Ooh.
where investors are going to look at an environment of stagflation. I don't care how much more money these central banks print. Economies are choking on existing levels of debt that can't be changed. There'll be bankruptcies. Some of it will be wiped away. But we're just going to, at best, slug our way forward as far as economic growth is concerned. And what to me that's going to mean is that stocks, generally speaking, are going to have to retrench. There's going to be a lot of rotation within the market. People are going to be aggressively looking for whatever good, legitimate yields are still left because they're not getting it on sovereign debt anymore. And I think commodities, which have been beaten half to death again recently, are going to have a resurgence in the
I
next
was
year or two.
just gonna go there, Chris. I mean, you're talking about the '70s, and we all know what the gold market did then. What a wild ride on Monday after the Swiss referendum failed to pass. Wild day in that. Gold here back above 1,200. Is that getting a little bit of a place in your portfolio now?
Well, it is. I mean, I'm nowhere near as heavy into the gold area as I was a few years ago when it was really hot, but I'm in baby steps starting to move more into that direction. I think gold has been in a bottoming process. It's interesting to look at the internal dynamics of the gold market where you've got such extraordinary demand among a lot of central banks in different parts of the world. Even individual investors in this country that are buying gold and silver coins as fast as they can. Keep in mind that when it comes to gold, when it comes to oil and some of these other things, the beating that they have taken since the middle of the year has not been because people got up and decided let's sell gold and let's sell oil. It's been a function of the dollar rising, and directional traders, when they want to go long dollars, they're usually going to find some offsetting trade that kind of a corollary to that, or I'm sorry, an opposite of that. So when you go long dollars, you're going to short what you think is going to get hit. So you're going to short gold, you're going to short oil, you're going to short yen and euros, and so forth. I'm one of those who does not believe that this run that we've had in the dollar since the middle of the year is going to go on for a long period of time. It can't. The ironic thing, having said that, though, Joel, is that when you look at the fundamentals and the relative health of the U.S. economy and the U.S. dollar on the one hand and the yen and the euro on the other, you can argue that the dollar should go a whole heck of a lot higher.
You
Problem
see,
is, if it does, everything blows up.
you see a gold run brewing here, or is this going to be a kind of a slow rally?
I think it's going to be a slow rally for a while. I don't think we're going to see any big acceleration in gold until the point comes when the Fed unmistakably tells us that, hey, we're going to cry uncle. We don't want the dollar going up anymore, and we realize that we can't let the rest of the world's central banks carry this load. We've got to get back into the game in a bigger way as far as propping things up.
Okay.
That's when gold will accelerate, but they don't want to do that yet.
So let's spend the last few minutes that we have on the show here talking about oil, and boy, that has been the news. First, let's talk about it from a fundamental aspect. What investors should and should not do based on the crude oil drop and the financial credit aspect.
Well, real quick, Joel, we saw back in 2008 the price of a barrel of oil based on in the market go from over $140 a barrel, crashing down in the 30s in several months' time. Neither of those figures reflected what oil should have been selling for based on supply and demand. Likewise, we have to look at the move of the last several months from $105 down to 67 or whatever on the West Texas Intermediate contract and say, did the demand crash that much? I mean, the IEA tells us that, EIA rather, tells us that global oil supply is about 92.5 million barrels a day. Demand is about 91.6 million barrels a day. So there is a slight amount of oversupply. Does that justify a 30-some% drop in the price of crude? No. Again, that has been primarily a function of traders bidding up dollars, and then the directional trade on the opposite of that is to short oil, and momentum has taken it down this low. I don't think it's going to stay down here forever, but what has happened is that you've opened up a lot of arguably great opportunities with some solid energy companies who have been beaten half to death. The industry itself is telling you that things have gotten overdone. You've got Halliburton looking to buy Baker Hughes. Yesterday you had a rumor that Royal Dutch Shell is looking to take over BP. There's going to be a lot of great opportunities in the service companies that don't get that much of a reduction in their own business with activity still at a high level, even though the oil prices drop. I love companies like Matrix Service Company, a little company in Canada called the Enterprise Group. Great, profitable companies that have got thrown out with everybody else. So there's going to be some really good opportunities for people that look at the fundamentals. The danger is, and I've been warning about this since the middle of the year, the danger is that apart from the fundamental considerations that you use in looking at the market and individual companies, we now run the risk of a financial or a credit event where there's a lot of these shale companies that are out there that are leveraged up to their eyeballs. One article I read recently, they're borrowing $1.50 for every dollar they're getting out of the ground. And what happens if this oil price weakness continues? If I'm wrong and the dollar index goes to 100 by the middle of next year and oil is $40, what happens when companies start missing interest payments and default on debts? And we have a ripple effect through the credit markets that might get out of hand. You know, Ben Bernanke told us back in 2006 and 7, oh, the only problems in mortgages are confined to subprime. And we know what a load of baloney that was. Well, we may, if this trend of the last few months continues, be looking at the next financial crisis where you substitute the term leveraged shale producer for subprime mortgage. That's something we've all got to keep our eyes on.
And just to wrap things up here, going into the end of the year, Santa Claus rally, many people are looking for. What a great run. I mean, all the market's gains have basically come since middle of October here. Is it a little bit too much too fast, or you think Santa Claus will deliver new highs by the end of the year?
Well, you've got a lot of money managers under pressure. It's been well chronicled that most managed funds have underperformed the market indices, and since we've had this big snapback from the October lows, the path of least resistance is going to be for stocks to move higher. I certainly wouldn't want to be betting against U.S. stocks until at least we get to January, and then I'm going to be thinking long and hard about it. I'm already short some European stocks. We've traded in and out a couple of times, shorting emerging market stocks and have made money on those. But right now, I wouldn't want to be betting against U.S. stocks. The path of least resistance for the balance of the year is up. But once we get into the early part of the year, I'm kind of looking for a repeat of this last year, Joel, where the early part of the year we had a lot of churning. We saw everything that had been depressed late in the year rally, and the stuff that was overpriced got sold off this last January. And traders should keep their eyes on those similar opportunities that I think will unfold in this coming new year.
Okay, Chris Temple, editor, publisher of the National Investor, coming on Benzinga's pre-market prep, brought to you by MarketFi, sharing his well thought out fundamental views on the market, the gold market, the oil market. Chris, thanks for coming on, and we hope to have you again after the new year.
always a pleasure. Take care and Merry Christmas. Happy holidays to all of you.